In this video, traders are going to look at 3 essential ways to manage risk as a professional trader. Stay tuned. Hey guys, warm welcome to you. Alright, so we are here to make money. Let's not beat around the bush. We just want to improve and grow our trading account size. That's why we trade. That's why we spend the time doing the analysis we do. However, if we do that but we blow up all the time and our equity curve is up, down, all we do is tread water and all we do is drain emotional capital, and eventually we're going to blow up our account. So risk management is the number one skill to really double down on. If you're going into the next quarter, next year, wherever you're watching this and thinking, what do I need to really allocate my time to get better at? It's not finding a setup, it's not understanding the market variables or fundamental analysis more, it's recognizing where the risk is in the trades that you're taking. So let's run through the 3 primary ways that we can manage risk. Now I'm in the C Trader account now. I'm just going to show you some different ways that we can manage risk within the account and also outside of the account and the way we're thinking. Because guys, if we don't manage risk, there's no point. It's just inevitable blow up is going to happen. And you know what as well, we have the way we're wired kind of guides us towards taking too much risk, guides us towards not wanting to take losses. So we have to be strict, we have to be disciplined, and we have to kind of look at this and say, hey, a professional trader is a risk manager. If I take care of the risk, then the profits will naturally evolve. I'm not going to say take care of themselves, because you've still got to be able to run trades and all the other parameters and skill set that we need. But if you can keep the risk capped and you don't get those big blow ups, especially if you're a day trader. If you're a day trader, you probably know, you've probably been through it all. You're running, cycling on, or cycling through trades, should I say, and then you're making money, and then bang, one big day wipes out a lot. If you can avoid that, just think where your P&L would be. So let's get down to some of the actual stuff that we can do. Now, most of you know, hey, the first thing we're going to look at is trading with a stop. If we place, we go, okay, here's our position, where are we going to put our stop loss? And that can be number of pips away, that can be the number of it can be price, so we can put in a price and say, hey, you know what, I'm going to have it 5,900, and that'll show you the number of pips away. That just ensures that if the trade goes against you, just for a long trade by the way, that just ensures that if the trade goes against you, you are going to get stopped out. So if the market suddenly falls 200 points over the next 3 or 4 days, you're only going to lose 110 points from this entry. And the reason it calculates that is it says, hey, I've put in the level that I want, I've put in, and it's going to automatically calculate the pips, or I can do pips as well. Now, the issue I have with using the pips on it is a nice feature to have, don't get me wrong, but the issue I have is you're not then aligned with the market conditions. And very briefly, guys, talking about stop losses, this is a whole topic by itself, but you kind of don't want the death by 1,000 cuts syndrome. There's no point in saying, right, I'm going to put an order in here on the FTSE on the UK 100. I'm going to go in for a pound a point. I'm going to put my stop loss, and I'm going to put my stop loss 10 pips away. Now that may seem like you're taking lower risk, but ultimately you're not, because you're taking that, you're going to get stopped out much more frequently, because the noise of the market daily range might be 100 pips, it might be 150 pips depending on the instrument you're trading. And I'm saying pips, but we could be points if we're talking about the indexes, or the indices, should I say. So aligning yourself with the current conditions. Sometimes a bigger stop isn't necessarily more risk. Think about how many trades you're taking in the week, in the day, in the month. If you're taking loads of stop outs, it's the same as one big stop out. So placing this trade here for a 10 pip stop, we could be stopped out literally within 10 seconds, 5 seconds, and then we do another, or all of a sudden we've lost 100 pips, 100 ticks. In reality, if we'd aligned ourselves with long, if that was a thesis we had, we could have had our stop 100 points lower, under the low of the day, feeling much more comfortable about things, giving the market room to wiggle and maneuver. So stop losses is a key one, but keeping it outside of the noise and being sensible about the type of trades that you're taking. Okay, so the second thing that we need to really be aware of, guys, is event risk. So this is going to be dependent on the market you're trading, right? But there's general event risk which covers all markets. So that's going to be things like the data that comes out, non-farm payroll schedule. It's going to be things like jobs numbers. There's going to be some market-specific event risks. If you're trading an individual stock, for example, then there might be an earnings call on that stock. If you're trading crude oil, there's the crude oil inventories that come out. So there's broad global economy event risk, if you like, and that's got bigger things as well, like election and Brexit and all this kind of stuff. That's bigger event risk. And then it goes down into kind of specific market event risk. Maybe there's an interest rate announcement on an unusual pair that you're trading, or maybe there's say an earnings announcement on a company you're trading. That's going down and down and down. So you need to be aware of where's the event risk for the market that I'm trading. So where's the binary risk, and where an event risk, guys. The reason an event risk is bad is it's because you are giving up control of the outcome of that trade during that event risk. If you're trading over non-farm payrolls, or if you're trading over an interest rate announcement or something, you are going to see the market spiking up and down aggressively. The market is going to move up and down. It may well end exactly where it started, and very often it does. The algos are swinging things up and down, especially when it's a meaningless announcement. But you have the chance, if you like, and of course it can work for you and against you, that something surprising comes out and moves the market dramatically up way more than you wanted, and you're not considering the event risk. Now, of course, if you're trading overnight, then you have the overnight risk, and you can't trade if you're having an individual stock, that is. So be aware of the event risk as well. But one of the good things that you can take from this, if you don't really get the event risk, is to go, okay, where's the market looking at? Is it looking forward to non-farm payrolls? Where's the event risk coming up in the week? What's the event risk that could drive CAD? What's the event risk that could drive gold? And then managing and understanding and framing your trades around that. Generally speaking, I don't particularly like to hold trades over big event risk. There are times when there's event risk on the calendar, so to speak, but actually no one's expecting much, and you may well decide to hold over that. That's got to be a commercial decision for you as a trader. So recognize an event risk. There's not really any excuse to be caught out by something you didn't know was coming. Almost everything is scheduled. Yes, there's some surprise news that can catch people out. You can't do much about that. You can look at that number 3 in a moment, but ultimately there's no real excuse if you're going to act as a professional not to know what's coming up and what's going to influence the market that you're trading. That brings me nicely, guys, to number 3, and number 3 is position sizing. You can mitigate so many of these things by trading with a sensible position size. So that means, if you have, and it's going to be dependent on a couple of things. It's going to be dependent on your account size, and it's going to be dependent on your tolerance for risk, not just account size. If you've got a $100,000 account, but you find yourself getting annoyed and frustrated if you lose £1,000, then you need to dial down the size to a level that makes you feel more comfortable. So, while we all want to make money, guys, and I get this, and the challenge for small account holders is that they want to make money, they want to make it meaningful, but they can't because they're undercapitalized. So I understand it, I get it. But if you can fight the urge to trade too much size, you can fight the urge to be trading, £20 a point on the FTSE when you only have a small account, you're maximizing your margin requirement, you've got $5,000 in your account, you're using as much as you can. If you can resist that urge, then not only will you be able to get experience and gain experience, but you'll be able to trade in a calmer manner, and you'll also be mitigating some of the risk we talked about before. So, if you've got a smaller size, you can widen your stop. If you've got £20 a point trade on, if you're trading 100 points stop on it, that might be so uncomfortable for you. You dial that down to 2 or 5, all of a sudden the trade risk becomes more comfortable. And then we look at the event risk. If you've got a small position size on, if some sort of unusual event came out, it's not going to harm you. It's not just going to move 500 pips against you, and you're going to get hammered, and you're going to end up having a margin call and all those things that you don't want. You can weather the storm a little bit. And also, you can think, maybe I will hold my trade through this event. Maybe I will hold it because I've only got a small position size. I can stomach this. It's not going to be too bad. And if it moves a little bit, that's fine. So think about that, guys. Think about the 3 things there. You've got event risk, you've got position sizing, and then you've got your stop loss placement. And if you're partnering with them, that's why they're sponsoring our channel. So go and check them out. I'll link them in the description below. Those are the 3 things. Keep your risk managed, guys. I say it all the time in the videos for good reason, because without capital, you're out the game. You can't keep funding your account. Eventually, your capital will run out. So protect it as much as possible. And when you have the opportunities, yes, push the throttle down. When you see the times to take a little bit more risk, calculated risk, fine, we're all there to make money, but be very, very cautious about when you give that capital, when you allocate that capital. Take care, guys. See you in the next one. Bye bye.